once again for the
Thank you.
opportunity. Bye.
Thank you very much. Bye-bye.
Good evening, ladies and gentlemen. Good morning. So let us start our next session. Let me talk about introduce Mr. Gary Cokins. The topic today, what we are talking is supply chain costing and performance management. Okay, so it's very interesting topic, and Gary is joining. I think it must be very early, right, Gary, for you. Yeah. So you are in mute.
No, can you hear me?
We can hear you. So let me
Okay.
give a quick introduction. Okay, so it must be very early, maybe 7:30 time for you. Okay, so let me give a quick introduction to Gary Cokins. So Mr. Gary Cokins, founder and CEO of Analytics-Based Performance Management LLC, USA. So currently he is joining from USA. So Gary Cokins spent 15 years as a management consultant at Deloitte, KPMG, and EDS. Following that, he dedicated 16 years to SAS, a leading business analytics and intelligence software vendor. So internationally recognized as an expert speaker, author, and consultant. His focus is on EPM, Enterprise Performance Management, and business analytics methods and systems. He has written multiple books, articles. He's a coach, consultant, help organizations to achieve excellence in enterprise performance management. Okay, so over to you, Gary. Welcome you, a warm welcome to you on behalf of our participants. So you can share your presentation, and our participants will enjoy your lecture.
Okay, Sheikh, I'm having some technical problems. I can't get to the big screen to open my slide.
Okay.
Oh, maybe.
Yeah, are you trying?
Yeah, I'm trying to. My PowerPoint should be open. Hold on.
In the slideshow, and then over on the top of it, you will see share.
No, it's open on my computer, but oh, there it is. Oh, it may be showing up.
Oh, yeah, we got you.
You're seeing it.
Yes, we are able to see it.
Okay, let me go to slideshow view. Can you see that?
Perfectly. Yes. Perfect.
All right. Let me see if I can advance the slide. Do you see that's landing page?
Oh, yeah.
All right, we're ready to go. Well, thank you for inviting me back again to the summit. Let me manage people's expectations. There may not be time for Q&A. It says 60 minutes, I believe, Sheikh, correct?
Yeah, you have 60 minutes, Gary.
And I'll try to move fast, but there may not be time. So a couple of options here. One, I suggest directly email me. There is my email address. So write it down, gcokins@garycokins.com. Also, if you go to my website, which is there below the horizontal tabs, there are a lot of free articles. You don't have to buy anything from my website, and a lot of articles, including stuff on supply chain management. So let's get going. Well, thank you for the introduction. A little bit more about me. I did get my degree in industrial engineering in 1971 from Cornell University, and my MBA from Kellogg, Northwestern's Kellogg School of Management. If you're doing the math, I am 75 years old, but I feel like I'm 45 years old. I've really had a wonderful career. First decade in industry with FMC, and then as Sheikh described, all this consulting with Deloitte, KPMG, and then I was 16 years with SAS. Maybe people don't recognize SAS. It's the world's largest privately owned software vendor, 15,000 employees that specializes in data science and analytics. Why are those books there? I think careers have a lot more to do with luck and circumstances than being smart and competent. And I had a lucky break in 1988. KPMG struck an exclusive contract with the Harvard Business School professor, Robert S. Kaplan. People recognize his name from his creation of the strategy map and balanced scorecard. But he did the early pioneering work on activity-based costing. So I got recruited from Deloitte. I love Deloitte, but I didn't want to pass up the opportunity to be trained by Kaplan. I implemented activity-based costing for 5 years. I wrote a book, and it led to a whole bunch of other books. So let's get going. Who will benefit from this presentation? Managers who have previously struggled at promoting enterprise performance management, EPM, supply chain management, and integrating business analytics into their decision support systems. Managers who intend to champion any or all enterprise performance management, supply chain, business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks has been, it's my observation that although it's nice to have senior executives advocate and sponsor innovation and new ideas and techniques, often they are preoccupied with firefighting and short-term priorities. So it's typically managers 1, 2, 3, 4 levels down in the organization chart who are passionate and ask themselves, how long do I want my organization to continue to perpetuate using stale or arcane or out of date or flawed methods? And they're the ones that'll do a proof of concept or a pilot project to demonstrate to their fellow coworkers, executives above them, that this is the way to go. So if you're young in your career and down in the organization chart, that's fine. I like presenting to you. So my agenda, I'm going to first introduce what is this enterprise performance management. Then we'll get into the whole idea about supply chain partner collaboration. Then we have to do some fundamentals about management accounting. And then we're going to conclude with a real frustration I have. What's taking so long for organizations to implement these methods? So now there is confusion and lack of consensus. What is enterprise performance management? Is it HR, personnel, employee appraisals? No, that's just performance management. This is enterprise. Is it scorecards, dashboards, KPIs, and measures, as well as aligning the strategy with the executive team? That's the world of the strategy map and balance scorecard. Is it about process, productivity, and quality improvement? That's the world of lean management, Six Sigma, cycle time reduction, quality improvement. Or is it even all the above? And the good news is this: enterprise performance is not really a single system. It's the integration of multiple methods, cost and profitability reporting, and enterprise risk management, lean management. The problem is when organizations do implement them, they implement them in isolation of each other. So you've got, strategy people in one part of the building, you got accounting, profitability reporting, another part of the building, you got process improvement, another part of the building. You get a lot more power and synergy when you seamlessly integrate all of these methods like gears in a machine. So performance management at enterprise is really the whole shebang. And I believe that the audience has been provided or will be provided a PDF of the presentation. So there's the definition that I just gave. Now, there are also many different many different reasons for interest in enterprise performance. Just real briefly, the first one, executive frustration with strategy failure. They're good at formulating strategy, problem, successfully implementing it. Next, increased accountability. Today, there's no place to hide. You will be measured, you will be monitored. Doesn't mean your job's at risk, but it could adversely affect your salary increases and job promotions. 3, more rapid decision making. Unlike a few years ago, you could test and learn and have meetings in conference rooms. Today, people are on the phone, go or no go, yes or no. They need to make a decision in real time. 4, mistrust of the management accounting system for transparency and accuracy. The reality is most managers do not trust the management accounting system. We'll talk about that. It has to do with the flawed overhead allocation systems. 5, poor customer value management. The reality is customers are the source of value creation, wealth value creation for shareholders and owners. We need to connect customers to shareholders. 6, contentious budgeting, poor resource capacity planning. That's a whole other topic, but I believe the budget is broken and we need to fix it. We basically need to go to capacity sensitive, driver-based rolling financial forecast and budgeting. 7, dysfunctional supply chain management. I'm going to talk about that in this presentation. And finally, unfulfilled return on investment promises from large IT systems like ERP systems. And the issue there is if you ask the CIO, Chief Information Officer, who's just had their company go through 2 years of strenuously implementing their ERP system, you ask them, how well do you think the ROI has met or exceeded what the ERP software salesman sold you on years ago? They'd be hard pressed to say yes. That does not mean you don't implement ERP. You have to remain competitive. But the issue here is there's a difference between data and information. ERP systems produce a lot of data, transactional, but you convert the data into information, and the enterprise resource planning, the EPM systems produce that information. Now, why is trading partner collaboration needed? Incidentally, much of this presentation is based on a book that I co-authored. There you see it. And I'm not advocating you buy the book. I think if you actually go to Wiley, chapter 1 is a free download. So don't accuse me of, oh, this guy's pushing his book. I am not. So let's get some background here. Post-ERP and SCM challenges. In the 1990s and 2000s, businesses embraced enterprise resource planning and supply chain management to automate relationships and increase efficiencies. These either eliminated or they shifted costs to different partners and the trading partners, but they didn't address three key challenges. And here are the three. The first one is adversarial relationships. Most customers treat their supplier as the enemy. We basically, let's see if we can negotiate lower prices with them. If we put them out of business, so what? We'll get another supplier. This has got to stop. It needs to be a marriage. Trading partners in the supply chain are in this together. They're competing against other supply chains. So they need to basically collaborate to identify mutually beneficial, cost-saving opportunities amongst the trading partners in the chain. So while each trading partner knows there are mutual profits to be gained, decades of arm's length and adversarial behavior has precluded the efficiency gains. Next, a procurement focus. There's immense pressures placed on the suppliers, as I just mentioned. No, let's reduce their prices. But when we do something like that, the supplier is going to say, golly, I still need to make money and profit for my shareholders. So they may reduce their service levels to you, or in some way just basically not be as good a supplier as they could have been. So the pressure goes from right to left. And finally, a suboptimal internal focus. It's no longer sufficient to be the most agile, lean, and efficient firm. You are dependent, you're codependent on all your trading partners upstream and downstream to also be agile, lean, and efficient. So you basically operate almost as if you're a single enterprise, and this eventually creates the need for collaboration, working together to identify mutually beneficial actions and profits, okay? But first you need to know the facts. You need to know your own costs and your profit margins and who or what are causing them. And that requires a need to understand management accounting. So this is going to be a primer about management accounting. Now here's a quote from a retired Walmart. Many of you are familiar in the USA. Walmart is the huge big box. And so his quote was, many companies may find it near impossible to track supply chain costs, but it is a requirement for properly tracking, reporting, and measuring item performance. And it is a true prerequisite for advanced supply chain and retail optimization. So if we think about the supply chain with the trading partners, we have all of these, if you will, interfaces between a seller and a buyer. So the starting point is to measure the profits across the supply chain and identify those mutually beneficial opportunities. Okay. And this requires ABC. So let me give you a simple explanation because some of you are unfamiliar with activity-based costing. Imagine you go to a restaurant with 3 other friends. You order a little salad and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. I mean, you order the little salad, they ordered the expensive, they want you to subsidize and pay for their meal. So the simple way is if we decompose the indirect expenses, this is the overhead, into multiple cost pools, and then reassign them based on cause and effect relationships. So, the traditional butter spreading of overhead uses cost allocation factors like number of labor hours, number of units produced, sales amount, head count, square feet, square meters. None of those reflect the true consumption of the resource expenses by the products, the SKUs, and the outputs. So again, if you decompose them and trace and assign them, so in the sense, it's like as if the waiter or waitress brings 4 individual checks. You only pay for what you consumed. Now, the reason there's been interest in ABC over the last, 50 years has to do with this diagram. It's got the 3 universal components of any organization's expense and cost structure: the direct cost at the bottom, direct material in the middle, the overhead at the top. Notice over time, the indirect expenses, that's the what commonly called overhead, is displacing the direct labor. And when you ask people why, they'll say, well, automation, machinery, so forth. That's secondary. The main reason the indirect is getting larger is over time, all organizations have had an increased proliferation of different types of products, manufacturers, more colors, more sizes, more ranges. And the point is, whenever you increase the diversity and variation of your outputs, it just produces complexity. And the complexity causes the need for more and more indirect expense to manage it. So 50 years ago, when it was kind of homogeneous products, very simple, most of the accuracy came from the direct costing. You could butter spread that indirect, but that is not the case today. In many organizations, indirect overhead is 50% of the expenses. The direct is the other 50%. So we need to trace and assign them. Now, the problem begins with this first diagram to the left, a monthly responsibility cost center statement. Every manager on the planet Earth recognizes this statement. But when a manager receives this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control, and where does it go? And the answer is not much. I like to say that when managers get this kind of report, they are either happy or they're sad, but they're rarely any smarter. What activity-based costing does is it makes them smarter. Notice what it's doing here. It's converting the same 914,000 into a different structure. See, the responsibility statement, the data is not structured. It's structurally deficient: salary, equipment, travel. We have to change that data into information. So in the middle, we've got the information: key, scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And incidentally, ABC applies to all types of organizations: service organizations, banks, insurance companies, travel agencies, even government agencies. And then we reassign the 914,000 into the products, the service lines, the channels, the customers, just like the waiter or waitress in the restaurant. Now, I've rotated that previous diagram 90 degrees. It isn't as simple as, oh, we take our ledger expenses, put them into these activity cost pools, trace them to cost objects. No, the right side's more realistic, because you've got indirect, you've got support activities that support other support activities that ultimately support the frontline activities that interact with customers or make products. So it needs to be a multiple stage cost flowing. Now, I want to warn you, the next diagram is going to look complicated. I'll go through it briefly, but then the slide after it will point you to a link to a 20-page article I wrote that you can then read it more at your leisure. So here it is. Don't be too shocked. It's got the 3 universal components of any organization's expense and cost structure. We've got those expenses at the top: salary, phone, so forth. We've got the work activities in the middle, and they eventually pile up, into the final cost objects: products, services, and customers at the bottom. Think of all of those arrows as thin straws or wide pipes where the diameter reflects the amount of money flowing through. That's why this will always reconcile exactly. So if the organization, let's say it spent $2 million, euros, dollars, whatever currency you want, it'll be the exact 2 million of work activities in the middle, and they will pile up exactly into the bottom 2 right buckets: customers and business sustaining. What is business sustaining? It's a special category. There are going to be some expenses that have nothing to do with making products or delivering services. So things like the legal department or when the accounting department's closing the book. So we create a cost object there like senior management because they want the report. It's typically about 10% of a monthly expense, but the other 90% of the expenses can be traced. The bottom, I refer to that as like the predator food chain. You know, large mammals eat small mammals eat plants. We can trace all of the expenses to the product, so we're going to get much more accurate product costing. But notice that the customers are buying the product, so we then have to reassign even the products to the customers. That allows us to get a customer profit and loss statement. Direct cost, not broken. You may have data integrity issues there, but the IT department can fix that. I mentioned to you, I went through that slide very quickly, but if you go to this link when you get the slides, I'm a 30-year member of the Institute of Management Accountants, and I had a part-time role as the executive in residence after I retired from SAS 8 years ago, and I wrote different articles for their magazine. This link will take you to a much better and lengthier explanation of the previous slide I just went through. Now, what matters is what's the consequence when you do ABC. The vertical axis here is the percent error distortion from the traditional costing. Now, notice the horizontal line, that's your traditional butter spreading, labor hours, units produced. The backward S curve is the ABC result. So you'll notice when we go far to the left for the simple products and services, they've been overcosted, because it's a zero-sum error game. Some products are overcosted, the others must be undercosted. But to the left, they've been overcosted. And the problem there is when competitors who have much better information see that you've overcosted and then you marked it up with a percentage for pricing, they'll say, well, we'll just price a little bit lower and we'll still make a profit. But to the right side, for the complex products and services, they've actually been undercosted, so they actually are not as profitable as you would think. And the problem there is the sales force with their commission and incentive structure is of the impression that the products they're selling are very profitable. They're not. Some are not profitable. So the more that they sell, the more you lose money. Now, here's another real view of the real output from activity-based costing. You're looking at true results. This graph is often referred to as the humpback whale curve, because notice it looks like a humpback whale. The vertical axis is the net revenues minus the properly calculated and traced AB costs through that multi-stage cost assignment network. The horizontal axis is the cumulative buildup of the profit, but it's rank ordered starting with the most profitable product, the second most profitable product, and so on and so forth. The very last data point will exactly reconcile with the P&L. So like in this real company's example, they had 30 million in revenues, 28 in expenses to net out a $2 million profit. That's the last data point. There's always organization shock when the executive team and everybody sees this graph. Because in this case, it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products. You lost $6 million on the remainder to net out at $2 million. In their belief system, without ABC, this graph is this little blue line with a little hook at the end saying, oh yeah, some of our products are unprofitable. They don't realize the magnitude. And the problem is all of that broad average butter spreading is crushing and suppressing any accuracy. The blue line and the ABC modeling scheme, the multi-stage cost assignment, is detecting all that diversity and variation and creating the top line. So the top line's the truth, the bottom line, the blue line, is false. Now, some of you may be asking, what do you do about the unprofitable products? Do we abandon them? No, that could be a mistake. Because in some cases, like let's use an example of a men's blades and razor example. You may be selling the razor at a little loss, but you're going to make up the money with selling the blades. So you have to combine them. But here's the point. And if you remember anything from this 60 minutes, remember this: in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss, or the boss of the boss. So to the degree that they're making decisions on gut feel or intuition or their so-called sixth sense are flawed and misleading data like the blue line or office politics, the organization is at risk. Now, some of you may be saying, Gary, you're beginning to persuade me that we probably should be doing activity-based costing in our organization, but it would be a mudslide of data. There'd be 2,000 activities in it. The IT department would have extract driver quantities for all those 2,000. Every employee would have to fill out a daily timesheet, and employees hate timesheets, and so on and so forth. Those are all misconceptions. But the problem is that was the belief in the past. And so some organizations failed at implementing ABC. The models were way too large, way too complex. No one could understand them. They were not maintainable. I came up with a technique to implement an activity-based costing system in 3 weeks. And here's how it can be done. And incidentally, any consultants that are listening to this webinar, if you want to directly contact me, I can train you how to do this for your clients. It starts with a 1-day workshop, 5, 6, 7 cross-functional employees in the room. First, build a very high-level ABC model. We use commercial software, doesn't have to be purchased by the client. The next morning, bring in the line managers and the executives. They see what was constructed by these 6 or 7 people, very engaging because it's their own company. The light bulbs go on with everybody. Oh, that's how we get rid of that butter spreading. Oh, that's how we can validate our pricing. Oh, that's how we can see our profit margins layer by layer like an onion skin. Oh, that's how we can do benchmarking with apples and apples, not apples and oranges and so forth. Then a couple of iterations for a week or 2 to decompose the model, start replacing some of the percentage estimates. Because when you do model 0, it's all percentages, 10, 10, 80, 30, 30, 40. Allocating is always normalizes to 100%. In 3 weeks, you've got a permanent, repeatable ABC production system, not 6 months, and it's right size, good enough. Make your mistakes early and often, not later when the system is too hard to change. Why does rapid prototyping work? It has to do with this diagram. The vertical axis is the accuracy of what you might want to know. Let's say it's a product cost or an SKU. The horizontal axis is the administrative effort to conduct the data, calculate the data, validate the data, report the data. You'll always get an asymptotic curve where the accuracy goes up relatively quickly and then levels off to the right with diminishing returns on extra accuracy for the extra level of effort of work. What rapid prototyping does is it creates this big, thick black line. Notice we get accuracy up to 95% in just a little bit of effort. So stop there. Good enough. Don't go into hundreds and thousands of activities. A typical ABC model will have 50 to 70 activities. That's good enough. It's good enough for people to use the information. Now this is not external statutory reporting for government agencies. It's correct. If you get the statutory reporting wrong, you go to jail. But if you get the management accounting wrong, you don't go to jail. It just has to be, good enough. So this is why this method of rapid prototyping is more sufficient. I love this cartoon. You've got this answer board. To the left, simple but wrong. To the right, complex but right. Look how many are taking the left path. The convenient, simple but wrong. The CFOs and the accountants say, oh, we'll allocate that indirect overhead like spreading butter across bread, labor hours, because it's convenient. That data exists. Very few are taking the right path, which is to do activity-based costing. Notice on the left path, they're falling off the cliff, meaning with that bad, flawed data, they're going bankrupt. Now, let's talk about customer profitability. Excuse me. The value of a company is a function of the value from its customers. The only value a company will ever create is the value that comes from its customers, the current ones and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we've got a couple of problems. One is the accountants are not calculating customer profitability. They're stopping halfway down the income statement to just gross profit margin analysis. They're not including channel distribution expenses, marketing expenses, selling expenses, and cost to serve expenses. We need to go below the line. So, products and standard surface lines is not the only thing you should compute costs for. What about all the costs that have nothing to do with making the products and delivering the standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. And I'm going to make a case that the bottom half, the distribution, selling, marketing, is more important than the top half. Visually, what I'm saying is if the entire rectangle in this diagram is your total expenses, then the shaded is only what the CFO and the accountants are calculating costs. But what about the distribution, sales, marketing, general accounting? It's more important. Now we've got another problem: angel customers and demon customers. What do I mean by this? Every company has high and low maintenance customers. Example of high maintenance customers, these are the demon customers. They're always changing the delivery schedule. They're always demanding special, not standard product, always returning goods, always calling help desk. The low maintenance customers, your angel customers, you love them. They never do any of those, only buy standard, never change delivery schedule, never call help desk, never return goods. If those two types of customers, polar opposites, bought the same volume, same mix at the same price, they're not equally profitable. Why? Because the high maintenance demon customers are creating so much extra cost for you that it's eroding your profitability and making them less profitable. But what really caught my attention of this book was the subtitle, Discover Which Type of Customers, Which and Turbocharger Stock Price. So that's why we need to connect customer value creation to shareholder wealth creation. The real message here is sales volume is not equivalent to the profitability. So just because you got a high sales customer doesn't automatically make them proportionally profitable. Incidentally, this book was authored by two marketing faculty at Columbia University in New York. It doesn't talk about management accounting, so I would not buy the book to understand management accounting. What ABC does, and this is a decomposition of the multi-stage cost assignment network. I'm not going to take you through it. It is in that 20-page paper. But as we bring in and trace and assign the activity cost from left to right, what's happening is layer by layer by layer in the onion skin, the profit is being eroded. And this allows us to create a profit and loss statement for each customer. And you notice the margins are layered by an onion skin. If I've got 50 activities, I'm going to have 50 layers of margin. So a lot of visibility and transparency to support analysis. Now, notice in this fictitious case, this customer had a 30% product gross profit margin. But between the 30 and the 8, 22 more points of profitability are eroded, nothing to do with making the product, all with distribution, selling, and marketing expenses. So if you calculate those two broad swaths for each customer, you can put them on a grid that looks like this, where each circle intersection is a customer. And notice the most profitable customers are at the upper left, and the unprofitable customers are in the bottom right. Why? Because the profitable ones, they're buying high profit, gross profit margin from you, and they're easy to serve. The unprofitable ones are buying low profit margin mix from you. They're difficult to serve. So now the name of the game is move the dots, move the customers from the bottom right to the upper left. And Shake, that would be another presentation by some other webinar about how to improve customer profitability. But two examples that they would do in that webinar is unbundling and fee-based. The banks have been charging extra fees for depository accounts. The airlines charge you an extra fee for baggage, or if you want to switch from a middle seat to an aisle seat. So charge that extra amount of money. That's one way, and there are many other ways to move those dots from the upper right. So what's really happening here is there's a shift in the CFO's emphasis. The CFO typically is basically pounding on operations, get their costs down. They need to shift their attention to marketing and sales so they can better target which types of customers to go after. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits for shareholders and owners. So this means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back? And which types of customers are not attractive? And then for the customers that are attractive, the second question is, how much should we optimally spend attracting, retaining, growing or recovering each customers. And why do I have optimally in quotation, in italics? It is an optimization. Why? Because you can destroy shareholder wealth in two ways. Remember the subtitle of the book, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. Well, you can destroy shareholder creation one way by overspending unnecessarily on loyal customers for what is needed to retain them. So, you're whining and dining them, really giving them a lot of service. They were going to buy the same volume mix, same price anyway. So you wasted money. But you can also destroy shareholder wealth by underspending on marginally loyal customers who you're not giving any attention, you're not contacting, you're not basically treating them well, and you risk their defection to a competitor. So in the end, what is the optimum spending level for differentiated services? Because you can think of it kind of like a bell-shaped curve. I don't want to, or it's like Goldilocks if you're familiar with the three beds. I don't want to overspend, but I'd also want to underspend. So the CFO and the accountants can help provide what is that best level of spending in terms of services. Now, I am going to start concluding with a way to understand how to do process improvement using activity-based costing. What this is a more simple version of the multi-stage cost assignment network. Remember at the top, we've got the resource expenses, salary, wages, depreciation, rent, utilities, and so forth. In the middle, what I've got is the different departments, and the X's in the boxes are in activity. So remember, there's maybe 30 to 50 activities. With activity-based costing, the assignment, we then reassign the activities to the products, to the types of orders, large orders, small orders, international orders, and eventually the customers. That's the predator food chain, remember? So that ABC is used strategically. Its main purpose is strategic. We want to know, where do we make or lose money? We want visibility, transparency. But the process people, the lean management, what they're saying to themselves is, I don't care where we make or lose money. I want us to make or lose money, but that's for marketing and sales to know. What I want to do is reduce our cost, reduce our cycle time reduction, so I want to use a technique like lean management. And so the beauty of activity-based costing is, notice we can take the exact same activity costs, but now string them together horizontally like pearls in a necklace. Imagine a necklace with all of the pearls, the X's of the pearls. And with that, then the managers can start seeing, what are called the processes. And now those of you who are older may remember Michael Hammer. Anybody remember Michael Hammer from the 1970s? Some of you weren't even born in the 70s. Michael Hammer wrote a famous book called Business Process Reengineering, BPR. That was the acronym. And what he advocated is, he said, tilt the organization 90 degrees, focus on the end customers and how they place demands on work on you, not the organization chart, which is all with all of its silos. And then people like Ernst & Young and Deloitte, KPMG started to create these process diagrams of different processes. And the most, if you will, dominant process is order fulfillment. Take the order, complete the order. So with these process maps, I'm going to show you, then we would basically call what are called value stream maps. So by stringing the pearls together, what you're looking at here is each of the boxes, each rectangle is an activity. The vertical height is the amount of cost in the activity. And then what the lean management people will do is they'll score or tag the activities as value added or non-value added, or maybe a range in between. And so this then allows them to focus, because their interest is cost reduction, cycle time reduction, quality improvement, and so forth. And that allows them, if you will, to lower the cost, which increases the profitability of the organization. So I'm going to start concluding, and Jake, maybe I am going to have time for Q&A, with a major frustration that I've got. What is taking so long for organizations to implement these enterprise performance management methods, things like the strategy map and the balance score, driver-based rolling financial forecast budget, activity-based costing. What's taking so long? Why has the adoption rate been so slow, including supply chain management, performance management measurements, and costing? Well, why is the adoption rate? What are the barriers? Here are three barriers. The first one are technical barriers. They are IT related. Things like dirty data, so someone put poor source in for data when they first entered it into the system, But the IT department has a technique, a method, a tool actually called extraction, transform, and load, ETL. So it can clarify the data. Let me give you an example of ETL. Let's say we're a larger company with multiple divisions. Reliance Electric in India would be a good example. Many, many different divisions. But we want at the corporate headquarters to negotiate volume-based price reduction with one of our major suppliers. But here's the problem, and let's use an example. The supplier is General Electric. In one of the divisions, though, in their purchase, if you will, in their purchasing system, the purchasing database, they have GE. The other division's got General Electric, fully spelled out. Another one's got GEN apostrophe L Electric. Well, those are three different spellings for the same company. What ETL will do is it'll collect all three, actually all of the divisions, if you will, purchasing database, and it'll select what is going to be the standard we'll use, like General Electric, and then it'll replace that into all of the systems. Now we can then bring in all the purchase history with General Electric across all the divisions, and now we've got information to go negotiate price reduction with General Electric. Another IT problem is multiple hardware. So maybe one division's got Dell, one's got IBM, one's got Hewlett Packard, but the IT department could address that. The second barrier and obstacle is this perception of excess complexity and affordability. And, I gave you the example earlier about ABC. I'm sure many of you, when I started to even mention ABC, you said, oh, I heard about activity-based cost. It doesn't work. It's too complex. I know my brother-in-law worked for a company. They tried to implement it. It didn't work there, so they stopped using it. No, ABC is just full absorption costing done correctly, but you need to right-size it. So the technique like the rapid prototyping, remember I showed you that in 2 to 3 weeks, you can have a permanent, repeatable, reliable production system. So that shouldn't be a barrier. Incidentally, those of you who may be interested in implementing a strategy map with the balanced scorecard, the Kaplan and Orton, send me an email. I did not talk about it in this presentation, but I have a technique to get the executives in the room, produce a strategy map with all of the strategic objectives and the 4 perspective strategy map, identify the projects to accomplish them and the KPIs in 2 days. So it's again based on a rapid prototyping technique. But the biggest problem has got nothing to do with technology, nothing to do with software, nothing to do with systems. It's about people. And it starts with a resistance to change. People like the status quo. Don't rock my boat. I like what we're doing now. Or fear of others knowing the truth. Oh, activity-based costing. I don't want the other managers to know what my costs are. Fear of being measured. Fear of being held accountable. Oh, I don't want to be monitored. I don't want to be. And I'll just say it, weak leadership. Not every executive team has the highest IQ. So you really do need some really leadership that's got vision and inspiration that people will follow. If leaders without followers, they're just taking a walk in the park. So your success depends on how well and how fast the right information and intelligence gets to the right people. And Sheikh, I had not anticipated, I really talk fast, and we don't have to go for the next 15 minutes, but how would you like to what would you like to do now? Are there any questions or comments? Can anybody hear me?
Yes, Gary, we can hear you.
Oh, good. I thought we lost you.
No. I was just searching for Sheikh. I believe he stepped onto a call, which was important. Just a second. I'll just let him know that the session has ended. We surely have a few questions to be addressed. Give me a minute.
I'm patient.
Thank you.
Sorry, I just my mute.
And those of you who hopefully are still listening to me, there is another
Yeah.
speaker. There's another speaker, Prashant Southakal, who will be talking about data analytics. I'm a very good friend with Prashant. To be honest, I'm an advisor to his company in Ottawa, Canada. Prashant and I are both Northwestern University Kellogg MBAs, and if you got a chance to listen to Prashant's presentation, it'll be
Yeah.
really well worth it.
He had actually Prashant's session was the first one today.
Oh, okay.
So,
Well, if it's archived and people didn't see it, go listen to Prashant again.
yeah. His session was the first one. So
Yeah.
it was 10 o'clock Indian Standard Time. I think it's 10:30 Canada time. Okay.
Yeah.
So it was wonderful session, Mr. Gary. So it was really a fantastic session. Okay. So Gary, the concept of supply chain costing and performance management in the context of supply chain organizations. Okay. So what do you advise, especially for the mid-size and smaller organizations who are doing good business? So how can they embark into a performance management for their supply chains in a very simple step-by-step way? Okay, I know the conceptual, there is no question of disagreement. Everybody agrees that the methodology what you have just explained makes sense for them. Okay, but how to start the journey and how to make it very simple step-by-step approach? Can you just give a quick briefing and advice for the organizations to do it? Okay.
Well, first of all, I'm often asked, does this only apply to large conglomerates with multiple divisions? How many employees does one need to successfully and get benefit from this? And my answer is 25. 25 employees, small organization. And why do I just choose 25? The thing that really drives complexity is the diversity and variation of the products and services. So even with a company with 25, if you go to their warehouse or you're going to see dozens and dozens of products, colors, sizes, ranges. And so typically, even with a company with 25, maybe 10 of their employees are the direct laborers. Hope we're still there. Okay.
Yeah.
Okay. 10 of the employees are direct laborers. 15 are in the office that are indirect. They're the overhead. So you still want to basically trace and assign the indirect expense of the overhead. So 25. But the question here, I've sort of partly answered, is how to get started. The rapid prototyping method that I described, and if people really want to send me an email and I can send you a document. The building the model in one day with a workshop, bringing in the executives the next day, that gets the buy-in, a couple of iterations. That's a way to go. Let me briefly describe the rapid prototyping or the strategy map and the balanced scorecard, because I'm really a believer that strategy management is key. Most executives' biggest frustration remember when I went through the 8 forces was failure to successfully implement the strategy. And in the US, there's measurements that the turnover rate of CEOs in North America is increasing every year. And that's because board of directors are impatient and with their governance responsibility. So if the CEO is not implementing the strategy, Carly Fiorini at Hewlett Packard, they're gone. So here's the way I do rapid prototyping in one day. The night before, I have the 6 or 7 CXOs fill out 20 yellow Post-its. You're familiar with the yellow Post-it with SWOT, S-W-O-T, strength, weakness, opportunities, and threat. In the morning when they come in, I have across the wall, left to right, the 4 perspectives of the Kaplan and Norton strategy map, learning and growth, the process to customer to finish. Put the yellow Post-it under one of those 4, easy to do. Then I say, go back to the wall and look at other of these from the other people and move this yellow Post-its adjacent to others that are similar. And guess what? There'll be 2 or 3 clusters of yellow Post-its under each 4 perspective. That's the strategic objectives that are in the strategy map. That's 10 o'clock in the morning. We've got the rest of the day. Now for each one, what are the projects, the initiative, the core process, what's KPIs? So I'm back to the person who asked the question, how do we get started? See, I've just given you 2 examples. I'm a big on crawl, walk, run, fly, soar. You got to crawl like a baby. Start small, think big. And the beauty of iterations through these, if you will, rapid prototyping, is you learn at each step. And you learn, well, let's change that. We make a mistake because our goal is to get a permanent, repeatable production system, but we also want to get it in just a few weeks. So that's my answer to that question. Is there another question?
Yeah. So basically, see, when we talk about supply chain organizations, then so we have like a third-party logistic providers. So they have a very specific operations, like in the warehousing, in the fleet operations. They talk about order fulfillment kind of thing. So when you take an example of warehouse management, say, management operations in 3PL, okay. So one of the very very obvious problem is, so they have like 100 deliveries. They give importance for all of them in equal way, okay. Whether it is a cost or it's a service level or whatever. So, but there is no some sort of weightage for each delivery or some sort of the performance management applied. So because not all these deliveries are not profitable at the same level. So the way you pay attention should be different. Okay. So the how can we implement activity-based costing kind of thing in this environment?
I think I would combine 2 benefits from ABC. The first one is the customer profitability, because which customers are more important, which are less important or attractive, whatever you want to say. So we can start prioritizing. But we also need to know more accuracy about our cost. Let me just share an anecdote. 2 years ago, I was brought in. I get I'm 75, but different consulting firms will subcontract me. I was subcontracted to go to Pittsburgh, US, to implement ABC for Federal Express. I think everybody that's listening is familiar with, Federal Express. It was Federal Express ground in Pittsburgh. And the issue with Federal Express then is they've got a competitor coming in, which is Amazon. Amazon that did, Amazon starting to deliver packages, also the US post offices. But the Federal Express didn't really know enough about profitability by package size, by truck, by type of truck, by route, by rural versus interstate in the city. Just imagine the delivery to out in a farmland, in a farmhouse compared to just dropping it off at a place in the city. And so notice the combination of size of package, type of truck, big truck, small truck. So you would also need to know your profit margins in combined with which customer is more or less attractive. So I don't know whether I'm properly answering the question of the person, but come on, activity-based costing just makes sense. And the absence of activity-based costing, I'm going to get in trouble here, I think is irresponsible act on the CFO. So if there's some CFOs listening, I'm surprised they just didn't cut off or send you, Sheikh, an email and say, that man insulted me. But, but here's the opportunity for CFOs and accountants. Bring value to your organization. Your line managers, they want better information. They deserve better information. So you need to provide it to them, and you'll be praised. They'll be applauding you if you help them. That's my brief answer. Not brief.
So, yeah, so one more important point is whenever we talk about activity-based costing, so people think about very sophisticated software kind of thing. Okay, I think in one of your lecture at some point, so you just mentioned that you can do it in a simple way also. Can you just advise how can they start simple and then maybe do it in a simple tools like Excel or something to start with, and then scale up? Okay, what do you advise?
I am not a fan of using Excel for ABC. It's columns to rows, and an ABC, the multi-stage cost assignment network, is really more of a modeling. Costing's modeling. It's not T accounts and journal entries with debits and credits. I have a list of 10 commercial ABC software vendors. If someone's interested, there's one I'll name Cost Perform. They're in Amsterdam, Netherlands. There's My ABCM. They're in Sao Paulo, Brazil, but their customers and clients are all over. Those tools are not very expensive. And if you do the rapid prototyping technique with the consultant and a facilitator, and I can train people how to facilitate, you don't have to purchase the software at the beginning. It's really used to just, see what it's going to look like. Most 99% of them, after you've done it, you then buy the software, but it's not that expensive. So you're asking what's a simple way. It's not, there's called the KISS rule. You may have heard the KISS rule, keep it simple, stupid. But you may not have heard the corollary, the LOVE rule, LOVE, leave out virtually everything. So it can't be too simple, but we want to at least make it achievable and understandable.
Perfect, sir. Any final thoughts, any advice for the participants? Because we have many people are in. Yeah.
I have, let's see, my clock says 27, so we have 3 minutes. I have two concluding thoughts. The first one is this: in the land of the blind, the one-eyed man is king. In the land of the blind, the one-eyed man is king. If your competitors don't have the visibility and facts, and you do, because now you've got ABC visibility, transparency, you become the king, you dominate. The second observation, and this is more serious, is I believe in the past, the best executives and best leaders had the best answers. Today, I do not think that's the case. Today, I think the best leaders and best executives have the best questions. There's too much volatility. There's too much complexity. There's too much uncertainty for those leaders to rely on their sixth sense or their gut feel, or their intuition, or the types of answers they had earlier in their career that got them promoted to the executive level. They need to create a culture of investigation and discovery and tolerance for making mistakes, as long as you learn from your mistakes. So I'm really advocating what Prashant Southakal talked about, analytics, data science. It's here. Thank you very much, Sheikh, to Data Labs and Fruition for inviting me to present again.
So thank you very much. Thank you very much, and have a great day.